Omotola Abimbola from Afrinvest, one of the investment analysts, is live here in the studios this morning to talk us through that. Good morning. It's good to have you.
Good morning, boss.
I hope you had a nice weekend. Let's talk about that. But this is one news that is it particularly out of the blues?
Well, I would say so because we had no inkling to it until the minister came out during the week to announce it. But then I would say it's a very good move.
How come none of us heard about it? That's amazing.
Well,
government knows how to keep secrets.
Maybe they don't have to, but...
We didn't see it coming.
We never saw it coming. But it's still a very good move, I would say, because one of the major problems of the current administration is the high level of debt servicing cost. If you look at the 2016, actual expenditure outlay, you will see that debt servicing took up over 60% of government's revenue, which is quite significant. And as we go on, we are seeing that the fiscal space to continue taking on more leverage is being squeezed out by the high servicing cost. So what they hope to achieve here is to reduce that servicing cost so that they can unlock more borrowing potential to continue to finance year-on-year government expenditure.
Let's give this administration some pass mark in terms of, it looks like the administration is listening. Everyone seems to be talking about high costs of the level of debt to start with, then the cost of servicing, then the tenor.
Correct.
Then the private sector, which the central bank uses every opportunity to knock the federal government on the head that you're crowding out the private sector from borrowing because you're paying almost 20% on 30-day, 90-day treasury bills. Where is the market for everyone else? So it looks like, from all indications, this administration is saying, okay, hold on every second. We understand you. We understand what you're saying. How do we get this done? By restructuring treasury bills?
Essentially, what they're planning to do is a refinancing of existing debt obligation. If you look at the structure of Nigeria's federal government debt at the moment, you will see that about 25% of the existing obligation is via treasury bills instruments, which are short-term tenured, less than 365 days, and very expensive as well. At the moment, the federal government borrows from the private sector, from banks generally, from treasuries, pension funds, banks, insurance companies, etc., at a rate higher than 18% for 65-day borrowing in the treasury bills market. And that's about 25% of existing federal government debt. Meanwhile, we have external debt, which constitutes less than 20% of total debt outstanding. And then you can borrow at a much more cheaper rate of between 7 to 8%, depending on the tenor that you are borrowing from. So what they are doing now is a restructuring of the existing, refinancing rather, of existing debt obligations, such that they can go to international capital markets where there is a high appetite for high yield emerging markets bond, then borrow at a rate of between 6 to 7%, and then come back to the local markets and retire existing treasury bills using the borrowings from international capital markets. Essentially, it's a refinancing operation. Borrow from somewhere else at a cheaper rate, and then come to your domestic market and pay down on the maturing treasury bills, in order to lower borrowing costs of the federal government, and perhaps restructure the exposure, or rather restructure the distribution or the composition of domestic public debt. We've crunched the numbers, and we found out that the federal government goes ahead and raises $3 billion from international capital markets to do the financing. They'll be able to reduce the contribution of treasury bills to total debt outstanding by up to 5 percentage points. So that's bringing down the ratio from 25% of total debt to around 20% of total debt. And then, on the other hand, increase the contribution of external debt to total debt by the same margin, 5%, from 20% now to 25%, which we think is more optimal.
Yes, it's a very smart move. And I said this yesterday, because if you earn in dollars, with a Naira devaluation already, that's more Naira on the table. And the federal government can say, okay, everybody, thank you very much. Take your money. We've borrowed from you because it's a very smart business, very smart businesses. But one thing is this, of course, there's going to be a bit of downside to that because of dollar. Sometimes the way the dollar behaves.
Exactly.
It could be a little bit worrying for everyone holding that currency. It could be really hot.
It could be. I agree with you totally because one of the major risks of borrowing in foreign currency is that when there is a volatility, or rather a depreciation or devaluation of your exchange rate, then it means that you have to raise more Naira revenue to pay down on those debts. So essentially, the success of this plan will depend on Nigeria being able to sustain the current trend of improved revenue from crude oil exports. Because if we're able to grow our revenue from crude oil exports, then there wouldn't be any significant, foreign exchange mismatch when you want to pay down on your external debt. So I believe that there is a risk to it in terms of the FX volatility risk. But if Nigeria could just manage to be able to sustain crude oil production at this level, and perhaps we see, oil prices stabilizing in the current region, it might not be a significant risk. It might not be.
The guys on the street have to worry that this is additional $3 billion to our debt portfolio. Is it any cause for worry for the common man who will be listening to us and see what is going on and say, oh, looks like Nigeria is borrowing more, and then there's more for us to pay in the years to come?
Well, fortunately for Nigeria, we're a bit under-leveraged when it comes to external borrowing. Nigeria's total external debt as of today is $13 billion. And out of that, about 70% of that is majorly from multilateral lending partners like the World Bank, the Japanese, multilateral and bilateral in nature, from World Bank, the Japanese JICA, the AFDB and the likes. So these are more longer tenured, instruments that are offered at concessionary rates, between 2 to 4%. Nigeria's real, borrowing from the capital markets is less than $4 billion, and that's our outstanding Eurobond obligation. So taking the figure from $4 billion to $7.7 billion might not be too significant at the moment, and probably not be a cause for worry